Our next topic in the stream is investing for the real economy. Our speaker for this topic is Motlatsi Mutlanyane. Motlatsi is the head of alternative investments at Momentum Investments. Motlatsi will be looking at some of the challenges and the themes emerging in this new environment and how this links back to responsible investing. Motlatsi, over to you.
Thanks, Wayne, and hello, everybody. My name is Motlatsi, and I look after alternative investments. Thank you for joining this session. We're going to briefly look at alternative assets, their role in a diversified portfolio, their role in the economy, and particularly within the context of impact investing. As most of you may be aware, there's been a global shift in asset allocations since the GFC into alternative assets and real assets. Since 2008, global allocations into real assets has increased from some $3 trillion to as much as about $112 trillion as at the end of last year. Now, the reasons for this are well known, right? High correlations in equities, ultra low yields in bonds, and the continual search for yield. So the attraction of real assets is quite clear. And while the data on the impact of COVID is slowly emerging, what we can tell, though, is that diversified portfolios that had other real assets or alternatives in general seems to have fared relatively better than others. We all know, obviously, that volatility spiked to as much as, VIX was as much as 82.7 one day recorded, which is the highest ever recorded in March. And not only did volatility spike, but correlations also converged. So this obviously impacted mostly listed assets and not so much diversified portfolios. But having said that, we must also be aware that some alternatives also got obviously hit during that time. Some assets, as you know, closed down totally. So if you think about airports and some of the tolls, even though tolls have recovered now, airports and airlines to a lesser extent. Some assets seem to have escaped unscathed, and while others actually seems to have done well and benefited during the lockdown. Now, real assets, as we know, are driven by macroeconomic factors such as demographics, technology, government policy, sustainability, urbanization, and so forth. And these are the kind of factors that are behind the kind of distinct themes that are emerging now. So for instance, if you look at infrastructure, now we know that government has stated it, that infrastructure is going to be used to lead economic recovery for us here in South Africa. So we're expecting that over the next while, there'll be increasing investment in infrastructure to boost potential growth. Now, the recently launched infrastructure fund under the DBSA is a statement in this regard. And the kind of sectors that we expect will benefit from this are largely in the economic and social infrastructure space. So things like affordable residential real estate, water management, healthcare, transport, and similar. So if you look, for instance, at affordable housing, this is another one that's driven by a macro theme, specifically increasing urbanization. And this is an area that we know that government has failed spectacularly, and particularly the Human Settlement Department. They fail spectacularly at delivering in that space. And the private sector, as a result, has stepped in to try and provide affordable housing on commercial terms. This obviously has an impact on other broad-scale infrastructure areas, such as, for instance, transport infrastructure, schooling, retirement facilities, and so on. Another area is our energy policy, which finally seems to now have been sorted out after years and years of uncertainty and confusion. So we know, at least it's becoming clearer, that renewable energy looks set to take a large part of our long-term energy generation. So it will play a big role in that. And that's through the Renewable Energy IPP, through the emergency procurement program that's on now, so that's the risk mitigation IPP, through embedded generation at smaller scale of between 1 and 5 megawatts. And then finally, the other area is in ICT, where we know that policy together with technology are quite critical for infrastructure development in the space. Now, we know that there have been significant bottlenecks in this space too, right? Specifically around spectrum allocation, which has held up a lot of catalytic investment, particularly new technologies such as 5G. But thankfully, this too seems to have been resolved, because there was an announcement towards the end of October that spectrum allocation will finally be auctioned early next year. And then we're also expecting the integration of ESG into investment policies and investment processes to be expedited, both in the private and the public markets. We're expecting local sourcing of agriculture and agro products, which is one of the areas that actually benefited from the lockdown, to receive a renewed focus from investors and increase investment too. What is clear from all of this is that securing sustainable outcomes is a key theme that's driving infrastructure investment and is becoming a fundamental driver in the real asset space. And I guess this is why there's an increasing intent by investors to use their capital to generate an environmental or social impact. I mean, in the US alone, about a quarter of all assets under professional management are allocated specifically to impact assets and impact funds. So to remind ourselves what real assets are, now we know that the real assets is a broad definition and a mixed bag of sorts. What we know is that real assets, unlike financial assets, for instance, are tangible. So an investor actually has ownership of a physical asset, which in itself obviously is valuable. And they are key at points in the economic cycle, the business cycle and inflation cycle. They attract an illiquidity premium. They generally are more complex to value and actually to manage, and they're long-term in nature. Now, in a portfolio, though, their biggest role, and this is why investors are like them and are attracted to these assets, is that they obviously play a diversifying role in the portfolio. One, they give protection against the long-term loss of purchasing value. So while inflation, for instance, is not a big issue right now, it's quite muted now, and in the foreseeable future, at least in the medium term, we're expecting the trend obviously to start going upwards around 2022 and onwards. So inflation risk at that point will become an issue, and this is where these assets will come into their own. We know too that they have low correlation or negative correlation to listed assets. So they're able to bring the aggregate portfolio volatilities down. We know that some of them have contracted cash flows. So they're able to provide a very stable income. So you know well in advance the kind of income that will be generated from these assets. And this is obviously has value for people who are looking for a stable income. So think of income funds, for instance. This kind of assets will be valuable in that case. But also for liability managers, so people looking after LDI portfolios who are looking for cash flows to do cash flow matching of their specific liabilities. And then finally, they're able to release alpha by capitalizing on their specific premium. So things such as illiquidity premium, term premium, and complexity premium. So if you hold these assets to term, so if you hold them for the long term, you can expect a reasonable compensation for that. And similarly, if projects that your manager is invested in or you invested in as a real asset investor has project financing or very complex financial engineering, you can expect that it should be able to generate additional basis points of return to compensate you for this additional complexity. So the overriding feature, I guess, of most real assets is that they deliver a social benefit of one form or another. So whether that's in a low carbon footprint or that they play an important economic role with sustainable benefits. The benefits, though, are both economic and eco-social in nature. And on volatility, well, as I said earlier, we know that combining uncorrelated assets reduces your aggregate portfolio volatility and improves your risk-return profile. However, this is obviously highly conditional on the uncorrelated nature of these assets. Some obviously have overlapping features with listed markets. So when correlations converge like they did in April, it's not always clear how these assets will behave. So that's why it's important to understand their specific characteristics and their strengths so they can be properly positioned in a portfolio to play their role in different business cycles. So for example, we know that they can provide greater potential to outperform because of the specialist premium that I mentioned, such as illiquidity and complexity. And this performance, unlike other assets, will come at a lower volatility. So aggregate volatility will be lower without necessarily sacrificing your potential upside. So juxtapose this with impact investing. Now, impact investing, as we understand it at a macro level, also looks to tackle some of the greater societal challenges such as inclusive economic growth, climate change and mitigation of environmental footprint, increasing productivity and public-private partnerships to deal with a critical backlog in infrastructure, the circular economy and biodiversity. And while impact investing is still a nascent investment area, which we expect that it will become mainstream over time, the transition into impact investing is fundamental, and we think it's actually a reversible shift. If we, for instance, look at just the number of impact-focused managers, the number of products in this space that's growing, and the fact that due diligence has actually increased quite significantly, both in depth and in scale, to evaluate the type and the extent of the impact that these managers are promising. Add to that the fact that some investors define impact investing as avoiding doing harm. So they look at it, I guess, using a negative screen, whereas investors such as us, we take a more positive approach to it. And then there's also obviously the controversy about investing, let's say, in fossil fuel as an example, but then compensating by buying carbon credits, right? Whether this is truly can be considered as impact neutral investing, that's also controversial. So as you can see, real assets lend themselves naturally to the impact investing space. But that's not to say that by investing in real assets, it's a sufficient condition to guarantee impact investing. The GIIN, which is the Global Impact Investing Network, defines impact investing along three components. So they look at it as intentionality and additionality, return, and that is obviously financial return and eco-social return. And then thirdly, measurability and reporting. So to look at the first one, so what intentionality and additionality mean? Intentionality, I guess, simply means that the investor from the get-go has to actually be targeting impact investing. So it has to be something that's either defined in the investment statement or in the investment philosophy. So it doesn't just become a coincidental. It actually is a stated objective from the first go. Additionality, on the other hand, means that the net impact of the projects that you invest in are, first of all, have a positive impact, and secondly, the impact is measurable. And in our view, these two, intentionality and additionality, actually really capture what impact investing is. And that is, your intention when investing and the additional impact of your intention. So investors can no longer claim that they're doing impact investing unless they can actually demonstrate these two. In terms of how we are deploying our capital in the short to medium term, we focus our initiatives in sectors which we think are first on the up and will do well in the long run, in sectors that will deliver on our positive impact outcome, and in assets that align with our SDG objectives. And these sectors are energy, and these are for reasons obviously that I've mentioned earlier, social infrastructure, and this is in particular student housing. And we are looking to increasingly allocate to agriculture, to data, and to logistics. And these are also sectors that have done really well, or at least they've been emboldened by COVID. And we actually see that they'll have a greater and greater role within the real asset space. And they're also sectors that align with our 4 SDGs that we've adopted as momentum investments. And these are SDGs within the health and well-being space, education space, economic growth and workspace, and in innovation and infrastructure. And to a large extent, finally, they also actually are essential services, which means that they are capable of providing defensive and uncorrelated exposures within a portfolio. And this is exactly what you need your real assets to be doing within a portfolio. Thank you for joining this session. I hope you found it informative and useful.